Good afternoon, and thanks for joining us for today's webinar, Accounting and Legal Update for Employee Benefit Plans. I'm Dan, Partner and Director of ERISA Services with McKonly Asbury, and with me today is Danielle and Zach, along with our special guest, Renee, from McNees Employee Benefits and Executive Compensation Group. For those of you who don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more. If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog. If you have any questions for us during today's presentation, please submit them through the built-in questions function in the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain CPE credit for today's webinar, please keep in mind that there will be 3 polling questions throughout today's presentation, and you'll need to answer all 3 of those questions to get your certificate via email a few weeks after the webinar. The objectives of today's webinar include providing you with accounting updates, fiduciary considerations, a legal update, and also spend some time talking about lessons learned from recent court cases involving employee benefit plans. With that, I will turn it over to Danielle to speak on some technical updates.
Thanks, Dan. So the first item we're going to speak about today is a new auditing standard specific to benefit plans. SAS 136 was delayed because of the pandemic, like a lot of things. However, it is going to be in effect for the 12/31/2021 year-end calendar year-end audits. So it's coming, and it does have new requirements for all stages of the audit. And just to give a little bit of background on this, back in 2015, the Department of Labor did an audit quality study where they looked at a sample of audits from 2011. And at the end of the study, they found that 39% of them were deficient. So needless to say, Department of Labor not super happy. They go to the AICPA and they ask them for some help, and that's what this standard is doing. So if you go to the next slide. So what does this mean for a plan sponsor? Well, you're going to have some new acknowledgments in the engagement letter, specifically around the management's responsibility to maintain an updated plan document, including plan amendments. And also, if you have chosen what has historically been called a limited scope audit, it will also note that management is responsible for determining that a limited scope audit is permissible, as well as that the institution that's certifying those trust statements is qualified. There will also be increased focus on the Form 5500. Essentially what the standard says is that the auditor is required to obtain a substantially complete draft 5500 before issuing the financial statements. And so what's interesting about this one is, in my opinion, we were actually always required to receive this. I know that we always did. My guess is this was a deficiency that the Department of Labor was noting over and over, and that's why there's this increased focus in the standard on it. And then lastly, there'll be new management representations that will essentially just mirror those new items in the engagement letter. So is a limited scope election still allowed? Yes. So this standard does not change ERISA. It is still allowed. However, it's now going to be called an ERISA Section 103A3C audit. So a bit of a mouthful, doesn't quite flow like limited scope, but we'll get used to it. And again, there are quote unquote new procedures specifically outlined in the SAS 136. Again, I feel like these were things we were always required to do, but just to be more transparent and to avoid any confusion, they really wrote it all out in the standard. So for instance, we're required to obtain the certification. We're required to verify it's a qualified institution. We're required to compare the information in the financial statements to the certified trust statements. So I don't feel like there are any surprises there. Now, what is very different is the audit report. So right now for the limited scope audit report, it's a page and a quarter. With these ERISA Section 103A3C audits, the audit report is now 4 pages long. So some of you may be thinking, 4 pages, that seems like a lot, maybe a little overkill, but I actually really like this change. I feel like in the old audit report with the disclaimer of opinion, a lot of people had questions and concerns over that and weren't really clear as to what the auditor is doing. So that disclaimer of opinion goes away now with this new audit report. And so instead, there'll be what they're calling a 2-prong audit opinion. So the first part will be an opinion on whether or not the information not covered by the certification is fairly presented. And then the second part will be whether or not the information covered by the certification agrees to or is derived from the certified trust statements. So again, a lot of information in that report, but I think it's way more transparent.
Yeah, Danielle, I think it really clarifies what we're doing as part of the audit, especially when it talks about the certification and the responsibilities of management. I don't think there was enough detail in the last report, and I feel like there's always questions on, well, I have certified statements, but those certified statements cover the investments and investment income, but in some cases, not always. So I think this does a nice job of laying things out. And I would also say for those that aren't too familiar with this yet, the Employee Benefit Plan Audit Quality Center by the AICPA has some great tools for plan sponsors as well. So it's not just for us auditors and accountants looking at your plan financial statements. There are tools available to plan sponsors on that website as well. It's a great resource. We use it. I'd highly encourage those that are heavily involved in their plan to go out there and check it out.
I agree. Thanks, Dan. So I think we are on to our first polling question. Have you restated your plan document recently? Yes, no, not sure. And if you're not sure, this will be great because Zach is going to be talking about that next, about what you should be expecting as it relates to your plan document and restatements. So we'll just wait another couple seconds.
I think it's also a good opportunity, if you're not sure, to make sure you're consulting with your service providers as well, such as Renee, who we have on the line. I know we've worked with her and to look at our own plan document. And so it always helps to get that extra set of eyes, at least from a legal perspective, and other service providers to kind of help you navigate through that document. I know there's a lot in there.
So it looks like 27% said yes, 47% said no, and 27% are not sure.
All right, thanks, Danielle. Thank you, Dan. So as it relates to plan documents and retirement plans, there's really 2 key rules. So a tax qualified retirement plan is required to be documented, and then the plan document itself must comply with all Internal Revenue Code provisions. So we're currently in restatement cycle 3, which runs from August 1st, 2020 to July 31st, 2022. So there are a few considerations. By now, plan sponsors and their service organizations that maintain the pre-approved plans should be in the process of processing their restatement. If you're a plan sponsor and you haven't heard anything from your third-party administrator, I would suggest reaching out and inquiring about their restatement schedule. It could just be that they just haven't gotten to that point of the process yet, but it would definitely be worth an inquiry on your end. And just from a timing perspective, plan sponsors should allow a 4 to 8 week lead time for the documents to be restated. And then the plan document, as it's restated, it should be revised to encompass all of the current Internal Revenue Code provisions. So what are the next steps? So as a plan sponsor, we should be reviewing the revised plan document and confirm that the data is accurate as it relates to your plan. The new plan document will need to be officially adopted by the plan's plan administrator. And then after it's officially adopted by the plan sponsor will receive a copy of the new IRS opinion letter.
Hey, Zach, before you jump to the next slide, I mean, I think it's outside the restatements. I think it's just really good practice. Maybe set an annual calendar appointment to just look at your plan document, maybe check with your service providers regarding the plan document. Honestly, the plan document is that key document that kind of drives everything with the plan. If you're going through an audit, I can speak on behalf of us. We start with plan document. So again, assuming everything's in accordance with IRS provisions, we're looking at your own plan document to do our audit and make sure you're in compliance with that document. So whether it's definition of compensation, who's eligible to participate in the plan, that's driving everything else. So that's why we include this in this presentation. That's why it's important to be familiar with. If you're not familiar with it, you should become familiar, even if you have to sit down with a service provider to go through that. But I think it'd be a really good practice, at least on an annual basis, to make sure you're looking at that, making sure it's current. Talk to counsel, service providers. But yeah, I think it's a really good practice to make sure you're doing that on a regular basis.
Yeah, and just to pipe in real quick, and I think we'll talk about this later in one of the cases, this is, if you're not following your plan document, then that is one of the things that the DOL will actually come down on you for not doing appropriately. That is a cause of action for breach of fiduciary duty. So if you don't update your documents, but your procedures change, or the way that you implement operationally, and the DOL audits you, they could find a claim for breach of fiduciary duty for failing to update it.
No, and I would say that along those same lines with plan documents, I would probably say one of the most common things that we observe going through the audits is the definition of plan comp. And I know I mentioned that once before as I was just speaking, but it seems it's like, oh, this is how we calculate plan comp. This is how payroll does things. We come in to do the audit maybe for the first time, and we look at the document, then we go to the payroll reports, and it's something different. So it may have been management's intent or the sponsor's intent all along to do it one way. Plan document might say something else. So it's things like that. You want to be absolutely clear that you understand what's written there and compare that to what you're actually doing, because I think almost every plan we see, there's a slightly different variation of what plan compensation is. So it's little nuances like that that you want to make sure you're familiar with, because it can cost real dollars. I mean, if you have one definition of compensation, and I'm going off on a tangent a little bit here, but if you have a definition of compensation within that document and you haven't allowed your participants to contribute enough based on that compensation, you as a sponsor may be held liable to put some money back into the plan. So I know we're talking about restatements, but I can't emphasize the importance of that document enough.
Yeah, thank you, Dan and Renee, for those thoughtful insights. Next slide, please. Kind of going along with our plan document restatements, I just wanted to touch upon the hardship rule changes. The Bipartisan Budget Act of 2018 and subsequent IRS regulations have changed the rules for hardship withdrawals. So one of the things that changed is they removed the 6-month prohibition of contributions following the hardship withdrawal. So our HR folks, you might remember in years past, you would have to, if someone had a hardship withdrawal, you'd have to stop their contributions for a 6-month period of time. The IRS and the Bipartisan Budget Act have done away with that. It has been extended to allow profit sharing and stock bonus plan contributions, as well as earnings on those contributions. So that's a big change from last year. And another instance that has changed is loans are no longer required to be taken prior to a hardship withdrawal. However, this must be elected by the plan sponsor.
And that's an absolutely critical point. So while these things are available, you have to actually, again, back to your plan document, you have to elect to make them applicable to your plan. I would say point number one, it's huge. I think throughout my career in doing audits, we'd see hardship withdrawals taken and then maybe a month later, somebody's making contributions back in the plan. And again, I don't think they're frequent enough, and sponsors may not always have a great process in place to say, oh, they had a hardship, so they weren't aware that the participant went online and maybe elected to start contributing again. So this is big. I mean, I think it's important, and it only benefits the participants, which I'm glad they allow this to start making contributions back into the plan.
Next slide, please. And that brings us to polling question number 2. Who is responsible for ensuring reasonable expenses are paid from plan assets? The plan sponsor, plan participants, service providers, or all of the above?
Yeah, I think that's a great lead in as we get into our next topic here in about 30 seconds. But I think you're going to hear a theme throughout this presentation, especially as we get into some of the cases later into the presentation about expenses. And I know we'll talk about it later, but it's not always we're looking for sponsors to find the lowest cost providers and the cheapest expenses, but it's making sure you've evaluated. So reasonable, your definition of reasonable and mine may be completely different. But as long as you as a sponsor have sat down, maybe you have committee meetings, maybe you meet with management internally, and you have really good reasons for making the decisions for the expenses, the funds you're picking, that's the key. It's the documentation and making sure you support what you're doing and why you're doing it to benefit the plan participant. It doesn't always mean low cost.
And I think those meeting minutes are very important in that case, Dan. So you have that documentation to show you're doing your fiduciary duty.
And I see the poll results, 53% plan sponsor. I think while there's scenarios where there might be some other folks watching over the plan, I would agree. As a plan auditor, I'd look to the plan sponsor in most cases to make sure that they're not only internally, but monitoring service providers to make sure expenses are reasonable coming out of the plan. That takes us to our next slide, ERISA accounts. So some of you may have heard about ERISA accounts, some of you may not. I will say we do see, I'll say some. So we audit a lot of plans. We see some ERISA accounts, and I think over the past 3 to 4 years, we've seen more. But an ERISA account is basically revenue sharing amounts that come from investment providers. So you might pick a particular fund. As part of having that fund, there might be excess revenue. That excess revenue will then go to an ERISA account, which you can then use to pay plan expenses and allocate to participants. And that all sounds great, and it may be very good for your plan, but that doesn't come without some considerations as you have those accounts and to make sure you understand what they are. So I would say one key takeaway, just if you do have ERISA accounts, I would say make sure you understand they can be complex. We could probably spend a whole presentation talking just about these accounts. But I would say one takeaway is just to make sure you understand how your account works, where the money's coming from, and where the money's going. Next slide, please. Why it's important. So those funds we're talking about that may have revenue sharing, there may also be a different fund class of basically the same investment that costs less, maybe has less revenue sharing or maybe no revenue sharing at all. So you as the sponsor, along with I'll emphasize your investment advisor. So you along with your investment advisor for your plan is to make sure that the funds that you've selected and those that have revenue sharing versus ones that may not, that you've made the best decisions for your plan and for your participants. Because as the next point on the slide shows, if it's not reducing participant fees or really giving back to the participants, you might have a better alternative. And again, I can't emphasize it enough. Work with your investment advisor. So if you have an ERISA account, make sure you understand it, make sure you're talking to your service providers, and making sure you understand the impact on your participants. As I mentioned in this last point here, if you can't justify the fee or you're not seeking a lower cost share, go back to that definition of reasonable we were talking about. Let's just make sure you've thought through it, you've documented, you've talked through it, and whichever fund you've chosen and the revenue sharing, or if it doesn't have it, that you've documented. Otherwise, that's basically just gets back to fiduciary responsibility. So that's why it's in this presentation. That's why we emphasize it. We're seeing it more, we're hearing it more. We want to make sure that you're talking through it and understanding it as it relates to your plan. Next slide. Some of these we've already hit, but you just want to make sure it's beneficial. Number one, everything we do from an audit perspective and everything we do from a plan perspective for our firm, everything we look for as we're talking to our clients about how their plan works, if there's operational issues, is the impact on the participants. The DOL is very protective of the plan participants, not necessarily the sponsors. So they want to make sure you're doing the right thing by the participants. So you want to make sure these accounts, these ERISA accounts, are beneficial to the plan participants. I also think it's good practice to look at the fees, maybe at least quarterly, maybe more often, depending on how often you get reports, to see what kind of fees are running through your ERISA account. Make sure that they're the fees that should be running through. The last point, if you do have these accounts, we have seen cases where the money hasn't all been used and it might sit for a year or two. Not a good practice. You want to make sure this money gets allocated back to participants on a timely manner. And with that, I will turn it over to Renee to give us a legal update.
Good afternoon, and thank you, Dan, for inviting me to join you guys again. Next slide, please. So the first thing that I would like to talk briefly about is something that's not law yet. It's coming down the pipe, and it's the target date fund selections. And as everyone knows, typically when you have a retirement plan, you normally have target date funds to where an employee can just go in, hit a little button and say, you know what, I'm going to retire around 2025. So I'm going to throw my money in the target date fund. And I, as an employee, I just don't do anything else. And when I retire, I get I get my money out of that fund. Well, essentially a congressional oversight committee has said that, you know what, that's a little concerning. And the reason why it's concerning is recently the DOL had approved that target date funds can actually invest in private equity. And so what the Congressional Oversight Committee has done is called on essentially the Government Accountability Office to actually look into target date funds. They want to know, is there like a less expensive alternative to the providers of the target date funds? They want to know how do target date funds actually do compared to other mutual funds. Most of the time it's proprietary to whichever third-party administrator that you have, your investment provider. It's usually proprietary to them. So if my 401k is with Fidelity, it's usually Fidelity target date funds that are being used. And essentially this oversight committee is just saying, you know what, we don't really know a lot about them. And it's usually a lot of times the default that people are invested in. And so they want to look into it. So I would suspect that probably by the end of next year, we'll actually have regulations or at least guidance related to what fiduciaries should do when they look at their target date funds. In the meantime, fiduciaries should look at their funds to see what the expense ratios are and whether or not there is a good return and how they're doing to other compared to other mutual funds.
Yeah, I think that offers another opportunity to just make sure you're speaking with your investment advisors on a regular basis, because even from quarter to quarter, year to year, you can make different selections on what fund menu you offer to your participants. And Renee hit on a couple of those points. I mean, the target date funds, I think in general, make it much easier for plan participants. But what those participants sometimes may not know, and again, I'm not an advisor, but sometimes that easy may be coming at a cost to their future retirement plan assets. So that's why it's just important to make sure you, as the sponsor, understand what's in your plan and what you're offering.
So the next thing is cybersecurity. And I'm sure everybody is well aware there's been lots of data breaches lately. And so this is the, this is the DOL's new thing to look at. And what they did in April is they issued guidance essentially that was, best practices for record keepers and for fiduciaries, and also best practices for participants and best practices for plan sponsors. And what the DOL has done is, again, it's guidance, but as we all know, when the DOL issues guidance, it's not really guidance. It's something more than guidance. So next slide, please. So what the DOL has done in their guidance is that essentially if you are a plan sponsor, which I think the majority of the people on the call would be plan sponsors, if you're a plan sponsor, then you would then what you would need to do is, you would use their tips in determining whether or not your service providers actually are adhering to what's best practices for cybersecurity. And here is a list of things that you may want to do when you're talking with your service providers, like do they have industry certificates? Do they, and I will be honest, you need to ask your IT people what these certifications actually mean. But you would want to know, do they have the certifications? What level of encryption do they have? Is there data theft protection, and so on? You also want to know, the big question is that, do they have insurance to cover any breach? The DOL also suggests that plan sponsors actually add a provision in their contracts that address cybersecurity with their providers. And in the contracts, what you would want the providers to do is actually to agree to adhere to their own cybersecurity policies and to notify you of a breach. Because remember, when we're talking about retirement plans are not subject to HIPAA. If it were a welfare plan, it would be subject to HIPAA, and there's specific rules that have to be followed, but retirement plans don't have that type of rules yet. And what I am seeing, a lot of our clients are actually addressing this seriously, even though it's just guidance. They're starting to change their contracts with their providers. They're asking providers for copies of the audit of their cybersecurity policies. When they're doing this, obviously they're going to be working heavily with the IT department, because if you've ever seen a cybersecurity audit, it's approximately 300 pages of computer talk. And so you would want to, you wouldn't necessarily want your attorney to look at it and tell you if it's sufficient or not. You would want someone in IT to look at it and tell you if it's sufficient or not. Next slide,
I would also say, from this perspective, a fairly easy place to start, and it doesn't cover all the risk of cybersecurity, but a fairly easy place to start is, from a benefit plan perspective, most of your service providers have SOC reports, especially those service providers that are processing large volumes of transactions, such as your TPA, your record keeper. I know from an audit perspective, we always ask for those. We ask for what controls you have in place that you should have in place. But within those SOC reports, your service providers, outside of the contract you've agreed to with them, will give you all the controls they have in place. Or they may have subservice organizations from an IT perspective that also has a SOC report. They're going to have basically user entity controls in place for you to basically rely on their service. So it's going to go through a list of, say, 10 items and say, you as the sponsor, for you to rely on the information we're providing you and the risks of doing business with us, you need these 10, 12 plus controls in place on your end to make sure the data we're getting is good and secure. So you'll see questions as far as protection of terminals and accessing the information. So we've probably harped on SOC reports for a number of years, but with the cybersecurity initiative from the DOL, it's even more important that you read those SOC reports, because there very well could be something in that SOC report that says, hey, you're relying on our service, but we basically told you you had to do these 10 things. And if you come back, maybe there's a breach, not saying this would happen. I have not seen it happen yet, but I can see it being a possibility is you didn't go through and make sure you did those 10 controls to make sure the service came full circle and you can rely upon it. So highly encourage, based on this guidance, to make sure you're reading your SOC reports for your key providers and you understand what controls you need to have in place.
So the next thing that's come out, and again, I'm sure a lot of plan sponsors feel like we're kind of on a pendulum. Things were changing one way under the prior administration, and now we're swinging back the other way. And one of those is for the ESG, the environmental, social, and governance funds. And in the past, and when I say in the past, I believe it was last year, the Department of Labor came out and said that you can't take into consideration ESG when you're making plan selections, or when you're making fund selections for your plan. So you can't take into consideration like environmental or social or governance generally when making fund selections for your plans. So that was last year. So now we have a new rule, and under the new rule, you can. Now, the rule just came out in October of this year, and there's obviously a 60-day comment period, and then there'll probably be, there might be changes to the rule or not before the final rule comes into play. And next slide, please. But what this rule has actually done is say that you can take into consideration like climate change related factors or workforce practices when you're determining whether or not a fund is appropriate for your menu of funds that you're providing to your participants. And that's a good thing. It's always good to have a greater opportunity or a greater menu of funds to provide to your participants. Next slide, please. And also in these proposed rules, again, there was a change from last year in that in the past, or recently in the past, it was determined that you should that fiduciary does not have the law was that the fiduciary was not required to vote every single proxy or actually every single shareholder right. And that's what the law says. You're not required to do that. Now, this DOL is taking it out. And when they're taking it out, they're saying, well, we're not taking it out to say that you have to vote every time you get a proxy or have to vote every time to exercise a shareholder right. We're just saying we don't want the law to say that you don't have to. So that the DOL now wants you to actually look at what's being voted on and make a prudent decision on whether or not, based upon the cost of voting the proxies, it's prudent to vote on it. The proposed regs also remove 2 safe harbors. And what the 2 safe harbors were is that you don't have to vote on or spend resources to vote on items that wouldn't have a material impact on your investment, or that you don't have a large investment in, like a large holding of particular mutual funds or something of that nature. And again, the DOL is saying, okay, we're not saying that you have to vote every single proxy, but we're saying we don't want the law to be that we don't want you to have these safe harbors. The proposed regs also, they also eliminate the requirement that plan fiduciaries have to maintain records on proxy voting and other exercises of shareholder rights. Again, it's not that you shouldn't maintain records, it's just that they want to remove like a perception of like there's a heightened fiduciary duty related to that. They also want to remove the obligation, the specific obligation to monitor any third-party proxy voting, with the caveat of saying, again, we're just removing it. It doesn't mean that you don't have to do it. You have to comply with your breach of, you have to comply with your fiduciary duties. We're just not going to put it in the law that you actually have this obligation to do it. So next slide, please. Okay, so this is a big one. And this one has been, the locating missing participant has been a big issue with the DOL for years now. In fact, it was for the DOL's office in Philadelphia, it was like one of the #1 things that they were looking at, and that's whether or not you're locating missing participants. And what the DOL has found, especially for pensions, that if you're not actually making a concerted effort to locate your missing participants, then the pension's just sitting on the assets and making money off the assets, theoretically saying. And the same is with the 401k. So what the DOL has done is they've issued additional guidance in January of this year saying, okay, we're going to help you out. This is what we want you to do to try to locate missing participants. And most of it is common sense. Believe it or not, they actually suggest you Google the person to see if you can find them. You attempt to contact them at the last address that you actually had for them. The post office won't provide updated addresses for you anymore like they used to in the past, but the idea is that you attempt to contact them through the post office and hopefully it will get forwarded. Most of the time it won't, because if you can't find them, usually they don't have the forwarding address, and usually you find out that you can't find them because the mail is coming back in any event. But you should do other things like find out who the beneficiary is and pick up the phone and call the beneficiary and say, hey, look, we're looking for Joe Smith. Do you know where we can find him? You could do other things such as, if you're the employer and the plan sponsor, if, potentially the person is on COBRA. So you might have new contact information by just looking through your welfare benefits plans to determine, is the person on COBRA or is their spouse on COBRA, and go, and use that information to contact them for retirement plan purposes, because a lot of times employees leave and they just kind of forget about their retirement plan. But if they're on COBRA, they don't forget about their health insurance and updating their address for that. Next slide, please.
Renee, I actually had a client, interesting story. I mean, to Renee's point, I mean, this is the participants' money. They worked, they earned it, they were due. And sometimes we're not talking about small dollars. Like some of these checks, I think more often than not, it's probably small dollars. They forgot about their account. But there's also many other cases where we're talking substantial dollars. I think it was one participant in a legacy pension plan. The worker, I think, spent 30+ years with the same company. I believe it was like several $100,000 in their pension account that they had no idea was sitting there. And fortunately for our client, did all the right things that Renee's talking about here, went and searched this person out. Turns out the person that was due the benefits was really ill, racking up a ton of medical bills and really needed the money. They were very fortunate that they were able to track this person down. Went and actually drove to them to get all the documents signed to make sure that money went over to them. So again, it was life-changing for that particular participant. So might be a few dollars here and there, but some of these add up, which is why the DOL, I think, places so much emphasis on is making sure they get the money back to the participants and not sitting in the plan.
Right. And sometimes your missing participants are actually, and I thought this was funny, had a client who had a laundry list of employees that were missing participants. And I recognized the name of a couple of them as being current employees. And it was just that HR, for some reason, didn't really look at the list. They just determined that, their TPA just said that we can't find these people. So in HR's mind, well, the people were, they had quit and they were gone. And that wasn't true. There were 3 people that were on their list that actually still worked there. They had moved and failed to update their address with the TPA. So they were really easy to find. So the next case is, it's going to be a fairly important case. It's Hughes versus Northwestern, and it was at the 7th Circuit, and it has to do with record keeping fees and investment options. But why it's so important is it's gone up to the Supreme Court, and the Supreme Court has determined to actually look at it. So this is the backstory. It's Northwestern University, and Northwestern University had the 403B, which is the equivalent to a 401k for nonprofits. Nonprofits can have 403Bs and 401ks, but they had a 403B. And in it, they provided their employees with over 250 investment options. So can you imagine being a participant and opening up your retirement and the web portal and seeing that there's 250 things that you could actually invest in? Of the 250, there were 150 that were mutual funds. And those are rough numbers. It was 140 and change. And so what happened with that is one of the investment options that was given was an annuity through TIAA-CREF. And in order to get the annuity, Northwestern had to offer the CREF stock fund. And then they also had to pay TIA and TIAA-CREF an administrator fee for being record keeper for just those assets. And then they had a second administrator for other options that participants could have chosen from. And because of that, some of the fees were higher. So if you were in the TIAA-CREF, you paid a higher fee to participate in the annuity and in the stock fund, but you didn't actually have to be in that. You could have chosen a lower option from the other 240 something options that you had. So so essentially what happened is there was a lawsuit against Northwestern, and the lawsuit is essentially that the participants were harmed because it was higher record keeping fees because there were multiple record keepers, and there was higher fees associated with some of the options because of the number of options that were provided. And they were sued for breach of fiduciary duties. And what the lower court said was, simply because some of the funds and the option in the menu have higher fees doesn't mean that there was a breach of fiduciary duty, because the participants could have just chosen a different fee. But the participants in this case with Northwestern said that, well, no, something else that Northwestern did was, because they had all of these, hundreds of investment options and multiple record keepers, that the fees were based upon a percent of assets, and it should have been a flat fee of $35. And so that was a breach of fiduciary duty. And the lower court said, no, not really, because there's arguments for both, whether or not there should be flat fees or whether or not it should be asset based. But simply because it could have been lower doesn't mean that there was a breach of fiduciary duty. And the district court in the district court had dismissed the case for failure to state a claim, and the Seventh Court said, we completely agree, there is no wrongdoing here on the face of what we're seeing. The plaintiff said that that there's a split in the circuit, that the simple allegation that the fees could have been lower is sufficient enough to actually be able to sue an employer. And is saying that the Third, Eighth, and Ninth Circuit, that's the rule there, and saying that the Seventh Circuit didn't follow that rule. But what Northwestern was trying to argue is like, no, the Seventh Circuit actually looked at the facts and determined that based upon the facts, Northwestern did nothing wrong. So where we are now is the Supreme Court's going to look at this and determine whether or not an employer can be sued for having multiple record keepers and hundreds of investment options, whether or not that would be on its face a breach of fiduciary duty, to where they could actually be sued at the lower court. So it's going to be interesting. So the takeaway from this is a couple of things. One, don't have 250 options. You're supposed to have options for your employees, but 250 is, I would believe that would be very overwhelming for even an investment advisor to determine which option to actually put their money in. In doing so, you always want to look at fees, and you want to look at the fees that are being charged to your participants and determine whether or not they're high. You don't have to have the lowest fee, but you shouldn't have it structured such that your participants are at a disadvantage because of the type of investment options that you're offering them. And with that, I will turn it over. Oh, I'm sorry. I forgot about this slide. This is just a for your information slide because of the 2022 limits have increased, and that's just for your information to look at later. And with that, I will turn it over for the remaining cases.
Yeah, no, I appreciate that, Renee. Thanks for that update. And I know some of this stuff as I sit and listen, and as I talk to clients, and as we read through some of these cases, and we'll go through a few more here in a moment, it can be scary as a sponsor. I actually have one client that was looking to start a 401k, and we kind of walked through some of the things that they need to think about. And the question was kind of like, why would I do that? Why do I want to put ourselves through that? And my response is it's kind of table stakes in some cases, especially in a competitive labor market like we're in now. A lot of employees, they're looking for that 401k. So that's enough reason there so you can attract and retain talent. But it doesn't have to be scary. You surround yourself with the right service providers, right legal counsel, advisors, and the vast majority of the plans run without a problem. But just make sure you understand your plan, making sure you're talking to your providers, and making sure you understand what's happening in your plan is really most of what you need to do in having a 401k plan. Which takes us right to our next polling question. Why are you joining us today? The options are you need continuing education credits, you find out our webinars are beneficial to sponsoring your plan, or you're concerned about compliance with DOL and IRS regulations. Looks like we have a good mix. We do have 64% that need CPE, but hopefully, even though you dialed in for CPE, hopefully you took a few things away from the webinar. I am going to kick it over to Zach and Danielle to go through a few cases. This is probably one of the most interesting parts that we find of the webinar because you can hear some real world situations of things that are happening with plans. So things do happen. We'll hopefully give you some best practices on how to avoid those.
So our first case that we're going through is a very new one. It was just released November 1st of this year. So it's the Department of Labor versus RVNB Holdings, Inc. And essentially the Department of Labor is alleging that RVNB Holdings ESOP allowed the ownership interest to be sold for less than its market value. So they said the market value was approximately between 45 and 58 million. But then RVNB actually just redeemed the entire ownership interest for only 12.5 million. So significant difference there. And so essentially the ESOP participants got 12.5 million, and then the rest of it went to the board members and their children's trust. So not the way an ESOP is supposed to work. And then to make matters worse, the company was subsequently sold to a third party for 200 million. And then if we go to the next slide, there's just like a couple of more details. So the Department of Labor is seeking to recover 35 million in losses for the ESOP participants. They want to bar the defendants from acting as a trustee, fiduciary, or service provider for any future ESOP transactions. And so essentially their rationale is that the fiduciaries did not act with undivided loyalty to participating employees. They transferred most of the retirement's plan value from the plan and its employee owners to company insiders and relatives instead of the actual employees. And when I first read this case, all I could think about was, where was the independent trustee that typically an ESOP would have? And I think Renee and Dan have some comments on this, and Renee actually looked into this a little bit more.
Right. So because you're right, when you look at this, you're like, how did this ever happen? I would not want to be the attorney working on this case, or excuse me, working on the cell representing the ESOP. But in any event, there was an independent trustee, and when the independent trustee raised concerns about the way that they were structuring this plan or this transaction, the independent trustee was fired and a new trustee was brought in that rubber stamped it. And the new trustee is one of the defendants in this case. But from the beginning, it was actually a rather interesting case because a lot of times with ESOPs, there's you have an ESOP, which is a technical separate legal entity with different people who are trustees of the ESOP than with the company. But in this case, when the company decided that they wanted to sell, even though they were selling ESOP shares, they kind of negotiated the deal prior to involving the ESOP, and the DOL definitely did not like that and made note of that. But yes, and this is, I mentioned earlier that the DOL will actually allege breach of fiduciary duty if you don't follow your plan document. This was the case where the DOL said that the ESOP plan document was not followed, and that was a breach of fiduciary duty because of the way that they structured this deal. But I would think that anybody involved would have just, seen the red flags.
That's what I thought as well.
Yeah. Right.
So I think if we move on to the next case.
So our next case is Pinnacle Machine, and the company failed to remit employee contributions in a timely manner from January 2016 to September 2019. For our plan sponsors on the webinar, where this kind of ties into your audit, this would kind of tie into what we call our timeliness test. And this is where we kind of calculate the number of days it takes the employee contribution to get from payroll to the custodian or the individual that's holding the funds on behalf of the participants. And why this is so important is because the court found these fiduciaries responsible for this, and they had to repay almost $42,000 in employee payroll deducted contributions, as well as lost earnings as an opportunity cost, because those individuals lost the opportunity to potentially earn market interest on that money because it wasn't put into the plan in a timely manner. Similar to the ESOP case that we just looked at, the defendants are barred from serving as fiduciaries under an ERISA covered plan in the future.
Yeah, and I think a best practice with this is there's actually a couple good practices that I've seen. With everything being electronic these days, most payroll providers and service providers will offer interfaces. So basically payroll goes through, they transmit the data over to your service provider, the money happens, the transfer happens instantaneously. So we'll see like 0 to 1 days for the money to get there. Still see a lot of manual process. It takes a lot more effort. So if you're not looking into an automated process, I would definitely consider that. It kind of takes away this risk, makes things more consistent. But assuming you have a manual process, I think just tracking it on even a quarterly or a per pay basis, just so you don't wait for your auditors to come out and say, oh, we think 5 of these are late, and then kind of scrambling to make all the corrections with your service providers. So I think there's an opportunity both manually and to look at information systems to do the work for you.
Right. And what was interesting with this one as well is that one of the co-fiduciaries was the director of HR, and she was also director of accounting, and it was the owner who was also, I believe, the president or the manager of the company, who was the one who was actually causing them to fail to remit the contributions in the timely manner, and she knew about it and didn't do anything. So the DOL said that she, as a co-fiduciary, she's also equally liable because she knew about it and didn't stop it.
I think if we go to the next case, that's another example of failing to remit contributions timely. The one difference with this one is this one clearly included fraud, whereas the owner of the company failed to forward approximately $25,000 in employer contributions and $53,000 in employee contributions. And he was eventually sentenced to for 3 counts of larceny. He was required to pay $78,000 in unremitted contributions plus $8,200 in lost earnings. And again, he's barred from acting as a plan fiduciary. So I think what this case really highlights is that while it might be hard to imagine fraud happening in a retirement plan with so many people involved, it does actually happen, unfortunately.
And I think all those that are trying to do the right thing in their plans, do the right thing, have these folks to thank for why the DOL is so on this topic. Basically for the past 10 plus years, I think it's probably been at the top of the DOL's list. And it's because of people like this that are using the money for their own benefit.
Absolutely.
Next slide, please. So our next case was one that I found particularly interesting. This individual collected approximately $121,000 of pension funds and Social Security benefits under his deceased father's name for a period of over 4 years. So the investigation found that this individual made multiple calls and forged his father's names on official documents to defraud the Social Security Administration and the Central States pension plan. So the federal court ruling on this particular case study was 1 count theft of public money and 1 count theft from employee benefit plan. And this individual was ordered to repay $91,000 to the Social Security Administration and $30,000 to the Central States pension plan.
And then I think we just have one last case we'll go over very quickly, just looking at the time. So unfortunately, this is another case that involves fraud, but fraud within a health and welfare plan, where the former president of the United Industrial and Service Workers Union stole hundreds of thousands of dollars from the union's health plan to pay for personal expenses such as attorneys, loans, salaries. And he was found guilty of 1 count of conspiracy, 12 counts of theft, 1 count of making a false statement to a government agency, and then subsequently sentenced to 12 years in prison for embezzling. So I think this shows how carefully the Department of Labor is looking at all of these things and how seriously they take any fraud within the plans.
Yeah, and I know we're coming up here on 3 o'clock, but one thing I'd point out with this, we've seen similar cases more from the service provider perspective, and I would just emphasize, understand what agreements you have out there in your plans, what type of expenses you're paying. Maybe there's per transaction fee expenses. We've seen some examples where the service organization may have just inflated those per transaction fees. It might have been a small dollar amount, but when you see the kind of money and transactions running through these plans, it adds up, especially over a period of years. So just understanding your agreements, understanding what you should be paying, so when something is out of whack a little bit, that you're able to pick up on that as a person overseeing the plan. And I believe that brings us to our conclusion. So I will thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out to one of us and we'd be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who have requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Thanks again for joining us and enjoy the rest of your day.